Alphabet stock is crashing after reporting third quarter earnings results. Interestingly, if you've been following my channel, you will have known that Alphabet has been one of my top stocks to buy all through 2023, except for a couple of weeks ago when I informed my followers to sell the stock. I said it was partly because the stock price had appreciated so much in the year. You could look at the stock price from January all the way up to a couple of weeks ago when I made that recommendation and took Alphabet stock out of my list of top stocks to buy. It had appreciated significantly, so I said it was a good time to take profits. So in this video, I'm going to review Alphabet's latest quarterly earnings results, and I'm going to update investors and let you know if you can buy the stock on this dip here or if there's more room to go lower.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Let's jump right into it with these earnings results. Starting with the CEO, who said that the AI-driven innovations across search, YouTube, cloud, and Pixel devices and more are continuing to bring in more use cases. They're bringing in more customers and they are improving their services, to be sure. The CFO saying the fundamental strength of our business was apparent again in Q3 with 77 billion in revenue, up 11% year over year, driven by meaningful growth in search and YouTube and momentum in cloud. We continue to focus on judicious capital allocation to deliver sustainable financial value. And that's the thing I've been paying most attention to with Alphabet in recent quarters is the last part of that statement, the judicious capital allocation part. I've felt for several years now that Alphabet has been a little too generous with its pay, a little too generous with its hiring too many people. And so I was happy to see, well, not, I shouldn't say happy to see, that's not the right word, but I was pleased to see the company taking a more prudent management of its resources and not just spending and hiring just because it was generating so much profits that it didn't know what to do with it. So I'm happy to see the company taking a more judicious approach to their growth, to their spending, and that's paying off already. As you can see with these quarterly results, you can see earnings are up meaningfully. And let me show you here. Revenues were up 11% year over year. That's true. But look at operating income jumping from 17.1 billion to 21.3 billion. That's, in my opinion, more impressive than the revenue growth. Operating profit margin increasing from 25% to 28% in the quarter, and earnings per share jumping from $1.06 to $1.55. So big increases in all the right areas for Alphabet. So you might say, with all this good news, why is the stock price down so much? And I'll talk about that too. It was related to the cloud segment, and I'll touch on that in just a little bit. So Alphabet breaks down its revenue across its different targets, and it breaks out its cost across its different targets. And the thing I wanted to highlight in this section is the number of employees. I mentioned earlier they were laying off some employees, reducing the staff, and you could see 186,800 employees during this same time last year. Now they only have 182,381. So a reduction of 4,400 employees, and that comes at the same time when Alphabet's revenue is 11% higher than it was last year. So generating more revenue with fewer people. I love to see that. That's where Alphabet needs to focus on. Even though I wasn't too happy with the way Alphabet processed the layoffs, I think it could have done a better job. And I'm going to touch on why I think that's the case in a little bit later in the video. So in January 2023, Alphabet announced a reduction in the workforce, and as a result, they recorded employee severance and related charges of 86 million and 2.1 billion for the 3 months and the 9 months ended September 30th. So overall, $2.1 billion in severance that they paid for the people that they laid off. That's expensive. That's what I was not happy about the way Alphabet handled their layoffs. I thought they could have done a better job in reducing their workforce. For one, another option could have been, instead of firing so many people, just stop hiring people and let the natural quit rate reduce your workforce in that way. That way, you might lay off people slower, but at the same time, you won't have to have such a severance expense. It won't be so disruptive to the business while you're letting these people go. You're not deciding, you're not making plans on who you should keep and who you should fire. You're letting the people decide who should be let go and who should stay, right? Those that really want to stay with your company will stick around. Those that find better opportunities elsewhere will go elsewhere. So in that way, you naturally trim down your workforce while keeping the people that really want to stay there. And the people that don't want to be there, they're probably not as effective anyways if they don't really want to be there. Let those people quit and transfer to other companies. And you save yourself this $2.1 billion. Also, they're taking actions to reduce their global office space, and they have taken a $649 million expense for the 9 months ended September 30th. I wish I would see more of this from tech companies like Alphabet in stopping with this return to work. Stop trying to bring people back to the office. Let people work from home and use that as an opportunity to shrink your office space and shrink those costs and expenses, right? People would prefer working from home, and as a business, that should be an opportunity for you to shrink your office space because it costs you less when you have people working from home instead of having to provide people an office space to work from. So take that as an opportunity, shrink your office space, let people work from home. Unfortunately, I'm seeing more and more companies trying to reverse the work from home decisions and trying to bring people back to the office. As you might imagine, it's not popular with workers, and it's going to cost the company more money to do that. And their justification is that people are more productive when they come to the office. People are more productive when they come to the office, is their justification. And I won't argue with that statement. I'll say, okay, fine. If you think people are more productive when they come to the office, I'll give you that. But are they productive enough to justify that cost difference? And that's where I would argue against businesses. Yes, I would agree. Maybe they are more, I won't argue. Maybe they are more productive when they come to the office. But are they productive enough to make that office expense justifiable? And I don't see that. I don't think that's the case. And so that's where I would have an issue as a shareholder if management is trying to bring back workers to the office and trying to get them to come back and work at the office. And we're not even talking about the fact that people, how can they be more productive if they're going to spend, depending on what city you're in, 30 minutes, an hour, 2 hours commuting to the office for the as many days as they want you to come to the office for. Let's say it's only for 3 days per week and your average commute time daily is 1 hour. That's 3 hours per week you're spending commuting times 4. That's 12 hours per month times 12. That's over 120 hours per year you're spending commuting. How can you be more productive? The difference has to be substantial in your quality of work at the office versus your quality of work at home. So I have an issue with this, and I'm glad to see Alphabet is shrinking its office space and not going this route of trying to get people back to the office. One of the great benefits in investing in Alphabet stock is the pristine balance sheet, and that has only improved recently. Alphabet has $119.9 billion in cash and only $13.78 billion in debt. And with interest rates as high as they are, Alphabet can generate over $5 billion per year if they just put those cash balances in a short-term government bond. However, as an investor, I would prefer Alphabet do something more productive than just putting their money in short-term government bonds, because I can do that myself. I want the management team to find more productive opportunities than just putting that money in short-term government bonds. So during the quarter ended September 30th and the 9 months ended September 30th, Alphabet increased its cash flow from operations in both time periods. 30.656 billion in cash flow from operations in the most recent quarter. That was up from 23.3 billion in the same quarter the prior year. And then looking at the 9 months ended September 30th, 82.8 billion in cash flow from operations, up from 67.88 billion in cash flow from operations. This company is a cash flow machine, does an excellent job generating cash flow, turning revenue into cash flow. It's a very lucrative business model, the business that Alphabet is in, and it owns a dominant share in the business that it's in, namely in Google search and YouTube. It's generating strong cash flow, and one of the main reasons why I recommended Alphabet stock as a buy earlier in the year. Okay, so here's where I want to address the reason why Alphabet stock was down so much and why I think that might be an overreaction from investors. So let's look at a breakdown of Alphabet's revenues and operating income among its different businesses. So revenues here on the top, operating income below, and you've got its different business segments, including Google services, which include its advertising services, its Google search engine, and YouTube. And so you have Google services, you have Google Cloud, you have other bets, and then you have hedging gains and losses. And look at Google services, which I've highlighted here, includes ads, Android, Chrome, hardware, Google Maps, Google Play, of course, the two most important, Google Search and YouTube. 67.986 billion in revenue from that segment, which turned into 23.937 billion in operating profit for the company. This is the area I am laser focused on. However, the reason the stock price fell after these quarterly results, or what I've been hearing from so many investors, is the Google Cloud segment, which its revenue increased from 6.8 billion to 8.4 billion, and its operating income increased from a loss of 440 million up to an operating income of 266 million. This is the second straight quarter that Google Cloud has been profitable. But again, you can see it's a small part of the overall business. It's a small part of the overall profitability of the business. It's nice that it has this now new cash flow stream, this new stream of business that's profitable, but this isn't the reason why I would invest in Alphabet stock. If I'm investing in Alphabet stock, which I am a shareholder, I'm investing in Alphabet stock for Google and for YouTube. The Google Cloud is just a nice thing to have on the side. If it grows wonderful. But Google services, Google search engine, YouTube is the reason why I own Alphabet stock. And I wouldn't be discouraged with a slower or faster rate of growth from Google Cloud. That segment we've seen is under pressure. I can highlight what I've seen from Amazon, the industry leader in web services, and its revenue in that segment has been decelerating, although its profit margin has held relatively stable at 29-30% operating income. Its rate of growth has been decelerating. So it's understandable Google is behind in this area. I don't expect Google to win in this area. Basically, the prime competitive advantage I see for Google in the cloud business is that it's serving enterprises, and it already has a strong relationship with enterprises, given that its prime customer for advertising are enterprises and businesses. So that's the main competitive advantage I see for Google here. I don't mind if it grows a little bit slower in this segment. So that's not a concern for me as an Alphabet stock investor. So then if you're asking, is this stock price dip a buying opportunity? And I would say yes, I think it is. Alphabet stock is now trading at a forward price to earnings of 18.33, and so I think that's an attractive valuation to pay for one of the most dominant businesses in the world. So before I let you go, if you've gained any value from this video, which you probably have if you made it this far, please subscribe to the channel. It'll really help me make more videos just like this one. Thank you so much for watching.